In this video, I'm covering 3 types of liquidity that appear on every chart every day. How to spot them, how to trade them, and how to stop being the person who gets hunted by them. What is liquidity? Liquidity is simply orders. Markets move based on order flow. More buying than selling, price goes up. More selling than buying, price goes down. But for a significant move to happen, the market needs to reach a zone where a large concentration of orders exists. Here's the key insight most traders miss. Millions of retail traders learned the same playbook: buy support, sell resistance, put stops beyond the nearest swing point. That uniformity creates something powerful: predictable clusters of orders at predictable locations. Stop losses above swing highs, stop losses below swing lows, buy stops above resistance, sell stops below support. That stacking of orders is liquidity. Large institutional participants, who represent roughly 95% of market volume, need massive order flow to fill their positions. They can't just click buy or sell without moving the market against themselves. So they gravitate toward these liquidity zones because that's where the transactions are waiting. Once you accept this, random price movement starts looking very logical.
Equal high and equal low liquidity. Equal highs form when price hits the same resistance level multiple times. Equal lows form when price bounces from the same support level multiple times. Most traders think the more times it's tested, the stronger it is. Liquidity reality: the more times it's tested, the more orders have stocked up around it. That level isn't getting stronger, it's getting more loaded. And loaded levels get swept. 3 ways to use them. 1. As targets. If you're long, equal highs above are a high probability target. Orders above are pulling price there like gravity. If you're short, equal lows below will draw price down into that zone. Use them to set your take profit with confidence. 2. As warning signs. When you see equal highs forming, stop thinking about selling there. You know what's sitting just above that level. Price is more likely to push through, collect those orders, and then reverse than it is to respect it cleanly. Selling resistance blindly is how you get stopped out 1 pip before the real move. 3. As entry triggers. After price sweeps through the level and collects those orders, that's your entry signal. The stop losses have been triggered, the breakout traders have bought in, there's nothing left pulling price further in that direction. The reversal begins. You enter right as the real move starts. Look at this. Price comes down to this level 4 times, classic equal lows. Every trader who bought that bounce has a stop sitting just below. Price dips under, sweeps those stops, then immediately reverses with strong momentum. If you sold that breakdown thinking support was breaking, you got caught. If you were waiting for a long entry after the sweep, you had one of the cleanest entries on this entire chart. That's the difference liquidity awareness makes. To understand trend liquidity, I need to say something uncomfortable. Trend lines are not reliable trading signals. A trend is defined by its highs and lows. In a downtrend, lower highs, lower lows. The trend only changes when price breaks above a significant structural high. A trendline break doesn't do that. Price can slice through a descending trend line and still be in a perfectly intact downtrend structurally. So what does a trend line actually represent? A visible, widely watched level that thousands of traders are making decisions around. And that visibility is exactly what creates liquidity around it. Sellers shorting the trendline retest, stop losses above. Breakout buyers waiting for a push through, buy stops above. Second wave buyers entering on the retest from above, more buy orders. 3 layers of buy liquidity sitting right around the trendline. Now imagine you're an institution looking for a high volume short entry. What better place to find the buying you need to sell into? Price breaks the trendline, breakout buyers pile in, stopped out sellers are forced to buy back. The institution sells into all of that at scale. Price reverses hard. Every trendline trader on both sides loses. How to actually trade it? Stop treating the trendline as an entry trigger. Treat it as a marker. There are orders here. Then look at the real structure. Is the trend still intact by highs and lows? Is there a supply zone overhead? If yes, that trendline break isn't a buy signal, it's a sweep. And it's giving you a high-quality short entry right where all the trapped buyers are positioned. Here's exactly what this looks like. Structural downtrend, lower highs, lower lows confirmed. Supply zone overhead. Price pushes above the trendline, breakout traders buy. But the structure is still bearish. This is a sweep. Watch the reaction. Price reverses straight back down. Both sides of the trade hurt, except the trader who understood the trend line was a liquidity zone, not a signal. Using trend liquidity for targets. One more use. When you're in a trade and deciding where to exit, if there's a trend line below with multiple touches, you know there are orders there waiting to be collected. That gives you confidence to hold for a deeper target rather than closing early. The difference between a 1.5R trade and a 3R trade can often come down to recognizing the trend liquidity below and trusting that it will get swept. Type 3. Range liquidity.
Range liquidity explains something you've probably noticed but never fully understood: why price almost always overshoots highs and lows before reversing. Inside a range, in the middle ground, there aren't many orders. Traders aren't positioning heavily at random mid-range prices. The orders, stop losses, pending entries, take profits, are all queued at the boundaries. Below the swing low, stop losses from longs, sell stops from breakdown traders. Above the swing high, stop losses from shorts, buy stops from breakout traders. So price glides through the middle of the range freely, no resistance, and then as it approaches the boundary, it enters a dense order zone. Those orders get collected, price reacts, then it travels toward the opposite boundary to collect those orders. High sweep, low sweep, high sweep, low sweep. This is why ranges look so choppy. The market is just harvesting orders from both ends. How to trade it. Wait for price to sweep a swing low, that brief dip below the boundary. Watch for a strong reaction back upward. If that reaction breaks a recent internal structure high, you have directional confirmation. Enter on the pullback to a demand zone. Target the opposite range boundary, the next liquidity pool. The logic is airtight. You know why price reversed, it collected orders. You know where it's going, the other pool of orders at the top. Entry and target both grounded in order flow. Watch this range. Price dips below the swing low, just enough to hit those stops. Strong candle immediately back upward. That's the sweep confirmation. Entry on this pullback into demand. Target the high of the range. Price moves cleanly through the middle, nothing in the way, no indicators, no news, just order flow and liquidity.
In reality, these three types layer on top of each other constantly. A range forms, swinging high and low liquidity at the boundaries. Equal highs build near the top, equal lows near the bottom, adding extra order density. A trend line cuts across, creating another liquidity cluster retail traders are watching. When you can see all three simultaneously, your chart reading becomes a different skill entirely. You stop asking, will price go up or down, and start asking, which liquidity pool does price reach first, and what happens after? That question has a logical, structured answer every time. Your entry, your stop, your target, and your trade management all become guided by one framework. Follow the orders. Now, go to your charts. Mark your equal highs and lows. Identify trend lines retail traders are watching. Note the swing high and low boundaries of your ranges, and ask one question: where are the orders? Do that consistently, and your trading changes fast. If this helped, drop a like and subscribe, and I'll see you in the next one.